Hedge funds have sharply increased exposure to financial stocks, banks, insurers, and consumer finance firms in recent weeks, marking one of the fastest sector rotation of the year. The move lacked in client notes from major brokerages and picked up by market reporters reflects a mix of positioning for an improving profit cycle in financials, the search for yields and central banks' edge toward looser policy, and the temptation to exploit perceived valuation dislocation after a volatile 2024-2025. At face value, the rotation is sensible. Financials are highly sensitive to interest rate dynamics, higher net interest margins, stronger deal activity, and an easing regulatory backdrop can all boost banks and insurance profits. Hedge funds appear to be positioning for a scenario in which central banks, most notably in the United States Federal Reserve and to a lesser extent in the ECB, shift from a restrictive stance to a gradual easing cycle over the coming quarters. Markets have already priced in at least one Fed cut in calendar 2025, and commentary from market participants suggests a softening in the momentum that kept rates high earlier in the year. But the flow tells a deeper story about hedge fund behavior. It isn't just about macro bets. According to prime brokerage notes and reporting, managers have stepped up overall equity exposure and increased leverage. A combination that amplifies both upside and downside. Hedge funds are taking concentrated bets where they see asymmetric reward relative to the perceived macro risk. Banks and insurers are easier to value on normalized earnings than, say, high growth tech stocks, and they can benefit quickly if credit conditions remain stable and rates fall modestly. That said, leverage near multi-year highs mean fragility if sentiment flips. First, earning momentum, deal activity amid underwriting advisory has ticked up in pockets, lifting revenue prospects for banks tied to corporate finance insurers and are seeing steadier investment yields and the potential to reposition portfolios as rates evolve. While consumer finance firms can benefit from both improving credit performance and lending volumes, these micro factors make the sector's earnings outlook look more attractive relative to crowded growth sectors. Second, rate expectations and deal chasing, with central banks having paused or modestly eased after earlier tightening cycles, the path of policy is now the central narrative. If markets continue to price in cuts, or at least a prolonged period of stable but lower rates, financials can see margin stabilizations plus accelerated lending. Hedge funds are effectively trading that expected repricing. Recent data showing changing consumer inflation expectations in Europe and some signs of slowing labor markets in the US reinforced the idea that central banks might be more tolerant of growth weakness, which supports the bets. Third, valuation and relative attractiveness after the steep run in large cap technology and the pullback in late cycles. Several financial names trade at modest multiples versus their historical norms. Hedge funds see the combination of depressed multiples and comeback earnings as an opportunity to extract outsized returns in a medium-term window. The dynamics aren't uniform. In the US, large banks have recovered a capital strength and are benefiting from improving deal pipelines. Hedge funds are active in the both loan books and non-interest revenue plays. The US picture is also tied to the Fed's moves. Every whisper of a cut can trigger rapid repositioning. Europe presents a mixed bag. The USB paused for the rate easing after cuts earlier in the year, and the incoming data shows consumer inflation expectations edging up. A reminder that the euro area outlook is more fragile and heterogeneous. Still, many European financial trade are at relatively lower multiples than US peers, attracting managers who believe the USB will be patient but ultimately accommodative enough to support lending and corporate activity. Emerging markets are more idiosyncratic. Some countries' financial sectors still trade cheaply but carry higher macro and credit risk. Hedge funds tend to be selective here, attracted to specific stories, restructuring, policy shifts, privatizations, rather than the whole sector. This flow is far from bulletproof. Six risk scenarios merit watching. Policy surprise. In the Fed or ECB signals they'll keep rates higher for longer, or retighten financials could be hit in as duration and credit assumption reprise. The market is particularly sensitive to any hawkish shift and undermines the rates will be fall trade. Credit deterioration. Higher than expected consumer or corporate defaults would crush the consumer finance and regional bank stories. Hedge funds linked heavily and levered into the same names would be first move sellers. Liquidity crunch. If leverage is widespread, as some reports suggest, and the shock forces rapid deleveraging, price moves can be disorderly, amplifying losses. Regulatory policy shocks. Renewed regulatory lightening of politically motivated measures could dent profitability expectations. Earning misses. The rotation assumes earnings catch up. A quarter of disappointments could trigger quick reversals. Valuation tethering. If investors reprice risk appetite broadly, the relative safety of financial versus high growth stocks could invert. How different investors might act. Hedge funds, active managers expect continued tactical trades, pair trades, long selected financials, short vulnerable cycles or growth names, and use of leverage to amplify returns. Many will keep a watch on credit spreads and funding costs as early warnings.